This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey there, Jason. Thanks for reaching out. What can I say? My life has truly been changing here since I joined your network. We just covered so much more in depth that we did not do in Jacksonville, especially that mortgage side. My wife was really impressed with that. Thanks again, and I look forward to continue nurturing this relationship and overall just awesome experience.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Hello, empowered investors. Welcome to the Creating Wealth Show. We've got a great returning guest for you today. We have Senior Housing Analyst at the Cromford Report, Tina Tamboer, who will give us the latest housing market updates. But before we get to that, to all Empowered Investor Pro members out there, don't forget we have our monthly meeting tomorrow night, August 2nd. And make sure you check out the forum for new announcements because we have some very exciting workshops coming up in the next 2 weeks on August 9th, 11th, and 17th. On personal banking, mortgages, syndication, tax-free 1031 exchanges, all very important topics, so you don't want to miss any of those. But without further ado, here is Jason Hartman and Senior Housing Analyst from the Cromford Report, Tina Tamboer.
It is my pleasure to welcome Tina Tamboer back to the show. She is with the Cromford Report, and she is a returning guest. We got such great feedback on her last time. I wanted to have her back because we might be at an inflection point. Tina, welcome. How's the market?
Oh my gosh. It's very exciting for an analyst, I have to say. Typically when we're doing our analytics every week, there's not a lot of movement. Lately, over the last 2 months, going into 3 months now, we started to see a shift in February. It was very slight. It was slow. Nobody really noticed it. But over the last 9 weeks, every week, we have seen a significant shift, specifically in supply and demand at the same time. So when those two things are shifting and not always in relation to each other, they are and they aren't, right? It creates a very interesting dynamic right now where somebody's experience, say on the higher end of the market, is going to be different from somebody's experience on the lower end of the market. And you have different players, on both sides. So yeah, we have a lot of interesting things happening, and many people are, especially if you're on the investment side of things, needing to adjust. Way quicker than they have had to adjust in the past.
So we have seen pretty significant interest rate increases, of course, and we are seeing inventory go up in different amounts in different markets. I should remind our listeners and viewers that you only cover the Phoenix metro area, but
that's right.
Here's the reason. I know we've got people in 189 countries watching and listening, but here's the reason this is important. Tina's group has a unique methodology that you're going to learn a lot from. And Phoenix has historically been a hybrid, or really a linear market until the run up to the Great Recession last time around, and then it became more of a cyclical market. And now it's sort of this boom and bust type place, right? The other thing I want you to know is that when we talk about inventory increases and shifts in the market, always ask yourself life's most important question: compared to what? And these shifts are big when compared to themselves, but when compared to history, they're really small. So I just want to remind everybody of that. And Tina, I just want to share with you and reshare with our listeners and viewers before you dive in a meme that I posted on some of my social media. I posted
Love
it
memes.
twice. Yeah, it's a great little meme. I posted it twice and I made a little correction to it as the inventory started to bump up a little bit. Okay, and here's what it says. Let's say there are 1,000 buyers who can afford a home at 3% interest and 800 buyers who can afford it at 4%, but only 600 at 5%. None of this matters when there's only 100 homes for sale because we still have a massive inventory shortage. I then revised it and I crossed out 100 and I put 120. So there's a little more inventory, but still a massive shortage of inventory overall. So now dive into your stuff. I know you've got some visuals to share with us. For those in listening, we'll try and make them audible for you. So let's take a dive in.
So I'm just going to begin by saying the affordability issues in Greater Phoenix are nothing new. Okay. We've been here for a while. We've been talking about it for about a year, actually. It started to, if you follow the National Association of Home Builders puts out a home opportunity index. And the way that index reads is of the people who are making the median income, which has just been revised for Greater Phoenix in February as $88,800 a year. What percentage of homes could they afford that sold in the first quarter? And for us, if I remember correctly, it was about 44%, somewhere in there. Okay. That is extremely low. For us, our normal range is 60 to 75%. That's where we're happy. The only other time we've dipped below 60 prior to, obviously, the bubble was 2018, when interest rates took a year to go up 1%. We dipped below 60. And what brought us back into affordability was not prices coming down. What brought us back into affordability was interest rates coming back down. And then we popped right back into normal, right? So what our affordability issue is dealing with right now is that these interest rates over the last literally 5 months have gone up so fast that nobody can keep up. The lending community can't keep up with that. Creating new products and new offerings to keep things affordable. Jobs can't keep up with that. Incomes can't keep up with that kind of increase. And it's really designed that way because that's literally what they've said from the feds is they're basically wanting to slow down the housing market. It's like pulling the emergency brake, if you will. Yep. So when we start talking about like the difference between a crash and a correction, to call this a correction probably isn't really accurate, because a correction is if the market's already going in a direction. Say we were already poised for a curve, right? A curve in prices, a peak of prices. Say we were already heading towards that. And then somebody decides we're going to raise the interest rates by 2% in 5 months. And say, we're not seeing this right now, but say we do see a price response to that at some point, right? Then when interest rates release, say interest rates go back down, start to come back down. The correction is actually, as you pinch that hose, right? Yep. You pinch the hose on demand and those interest rates start to go back down. Guess what happens to that hose? Mm-hmm. And then all of that pressure starts to come in. And then your correction is actually the market going to where it would have been anyway, right? Not necessarily shooting up like it was before. Maybe by that point we'll have homes. Maybe by that point we will have found an adjustment, but we would have gone to where we would have been anyway. So some people might say, I'm going to share my screen now. How do you know? You know, why do you feel that interest rates might come down? And here's just a historical rate history chart. I pulled it off of FreddieMac.com. You can pull it off. It's public. I just took the date range, and instead of 5 years, I went back all the way to the 70s, just to show that sometimes, many times, when we see a spike up in interest rates like we have seen lately, it's not uncommon to see them come down almost as fast as they went up. And what I found interesting is if you think that there's a recession coming, which I don't do those predictions, but if that's what you believe, then every time we've seen a recession, about right towards the end of that recession, every single time we see interest rates shoot down. Every time. So, and when you look at the length of these recessions, they're not very long. A lot of times there might be a year. We had a long one. We've gone through counseling over that one already between 2007 and 2009. Been through my therapy on that. But the thing is that when we've seen it shoot up, took 10 months to go up in 2018, 6 months to come down, 4 months to go up, 3 years to come down. But oftentimes 19 months, 18 months, 10 months, 14 months. What is the probability that as this shoots up, that interest rate will start to come back down?
Yep.
At some point, right? So this means for a buyer today, so yeah, maybe I'm going to get 5 or 6%, which by the way, historically is still very low, right? I'm going to get 5 or 6%. I'm disappointed I didn't get, 2.5 or whatever. Disappointed I didn't get that, but your payment is not permanent. If you know that I'm going to hold on to this for a couple of years, I can afford this payment. Maybe it's not as big a home as I wanted, but it's something that I can handle. I can get my foot in the door. And then a year or two down the line, I refinance and now my payment goes down. And after my accumulation of equity comes out, if there's another rate drop, I get to refinance again. I get to grab, I don't take your equity out, but again, you take the PMI off and all of that.
Exactly. So that's what I'm always saying to investors. Real estate is one of the few asset classes where you get to buy the property and you still get to constantly renegotiate the deal.
Yes.
It's like you can keep changing the deal by refinancing it, by doing something different to it, by improving the property, by whatever, right? You're essentially renegotiating the deal all the time.
Yes.
Whereas most things that you buy, once you buy it, you're locked in. If you buy cryptocurrency, stocks, whatever, that's the deal. You made the deal. It's done. Right. But with real estate, you can constantly change the deal.
And to your point too, many people, buyers, especially new buyers, people who are not used to owning their own home, they are waiting for prices to come down. But what they really mean is they're waiting for payments to come down.
Right.
And in the meantime, they're going to pay higher rents and they're going to be waiting. And these rents have been going up this whole time. They're waiting for these payments to come down, not realizing that payments are already very, very low up until literally 5-6 months ago, comparatively. And so people who even bought 2 years ago are doing extremely well now. Yep. And so the thing is that many people don't realize that they are shopping a payment. And if they can get in today, lock that in, and then their payment goes down later, they still get to wait for their payment to come down. Right. You know what I'm saying?
Yeah.
But you always want to make sure that you can afford what you're getting. And there are people that cannot afford these and they're having to rent, they're having to move in. And to the point of whether or not we think this is the beginning of a crash or the beginning of, some kind of bubble popping, that's where we point to the fundamental issue is how many homes do we have for all of the people who are here? And I can tell you during the crash of 2008, we did not have a homeless problem at all. We had way more homes than the people we had. We have more homes for everybody.
That's quite different today.
It's quite different today. So I would say that our homeless population today says we are not going to see a lot of vacant homes in this example here. Right. And that's what you need to see prices significantly come down.
Yeah, I agree. And, the builders will catch up to that a little bit, but the problem is much bigger than construction can solve anytime soon. And we all know what's happening to construction cost and materials prices, and not to mention supply chain problems, which hopefully would be temporary, but they sure are lasting a long time. So good points.
Yeah. So, to get into what we're seeing outside of that topic, which I'm sure we will dive in to the whole bubble crash correction topic, what's different from this market to 2005, for instance, because all of our PTSD is talking to us right now.
Right.
Whenever your PTSD and your anxiety over what you went through during that period of 2005 all the way to 2008 and 9 and 10, you have to put those emotions aside. Emotions are not facts. You have to lean into the numbers, lean into what's happening today. And so what's happening today, and I'll pop back into my PowerPoint here. So on the supply and demand, many of the professionals here, most of the professionals here and observers of this market knew that what we were going through is not sustainable, okay? When supply and demand are that out of whack, you're just waiting for the change to happen. And so now that is actually happening. And it was obviously on purpose instigated by these rate increases. But as the as we go through this change, there's a bit of chaos, there's a lot of anxiety, there's a lot of, oh my gosh, is this going to go the same way? Totally different thing. But let's just talk about what the actual numbers are here in Greater Phoenix through the MLS. This is your supply line. This is the 9-week period. I've said that we have started to see this shift from here to here, up 90% in supply in a 9-week period. That is a huge percentage gain, but as you can see, comparatively to other years, we're still extremely very, very low in the supply line. So we need to go through this period in order to get back to a level of supply that we would be considered more stable, okay? So the question is, why is it rising? When we measure supply, it's like measuring the level of water in a bathtub, okay? The minute I take that measurement, it changes because you've got new listings coming through the faucet, that pressure coming through. And then you've got your drain of contracts. Every time a contract's accepted, you got another one that goes out the drain, right? So why is it rising? Is it rising because we have a lot more pressure coming through the faucet and new listings? Or is it rising because our drain got clogged? Okay, and that got smaller. Or is it both? So when we look at this slide, this is telling us how many new listings over that 8 to 9 week period have we been throwing through that faucet. And as you can see, this yellow shaded area, that is where most of our years are. Notice 2006, 2007, 2008 had a lot of pressure coming through that faucet.
New listings.
New listings.
Right. Okay.
Coming through the faucet, adding to the supply in our bathtub. Okay. So the pressure is actually quite normal right now. But in April, it was kind of in line with 2021. And in May, it started to get larger. So we had more pressure in May coming through the faucet. And you can see it in this listing, in this chart right here, that shows 2022. And this goes all the way back to 2011 of how we are coming in hot for the summer. So more pressure coming through over the last 4 weeks. And this is our normal seasonality of new listings. They come in sharp in the first quarter, then they start to slow down during the spring, they bottom out in the summer, then we have a rally in the fourth quarter. That's
right. So I like your metaphor of the bathtub, right? Where, you know, when a contract happens and a property goes from for sale to pending, it's down the drain because it's gone, right? And the new listings coming on the market are coming through the faucet, right? That's the water coming through the faucet. And so the level of the bathtub is changing. But we have to also look at this issue of where was the level when we started? And it was so low. I mean, the inventory has been so extremely low that you've got to have a lot of pressure come through that faucet, and that drain's got to be pretty clogged up to get inventory back to a sort of normal balance, right? Now, this is not nationwide. This is only Phoenix. But Phoenix is such a boom and bust type of market nowadays. What is the inventory like overall?
Overall, inventory is still about 65% below normal.
Okay,
but we were 75% below normal, so now we're only 65.
Okay, so in other words, if the normal inventory was 100 listings, okay, I mean, just for easy numbers, right?
Yes.
The normal inventory was 100 listings. You only have 35 for sale now, right?
That's right.
But before, you only had 25 for sale before the rates went up.
That's right.
Okay. So you still have a big deficit of inventory, very significant. You're still 65 listings short. Yeah.
That's right.
Okay.
Absolutely. So what we're seeing at this point is that we have been, especially over the last 4 weeks, but really over the last 9 weeks, we went from having very weak pressure in new listings to a normal pressure and then a higher than normal pressure. We haven't seen new listings come in this sharply since about 2010, which is not a really good year to compare because 2010 was, you know, we were still in the recovery. It was not, it's not a good year. Yeah. This is what's going on weekly in accepted contracts though. So this is our drain, and our drain is getting smaller. At the same time, we're getting new listings coming through. And I put 2019 in because that is our normal seasonality for what we would expect in any given year. We peak right around May in the number of contracts accepted, and then it gradually declines until December as a seasonal trend. Last year, we had that trend was happening, but then we had some institutional iBuyers, meaning flip companies, Zillow and Open Door, decided to have a competition between each other over the last 6 months of the year, and they launched that trend higher than normal. It was not a true trend of what our buyer activity truly was. They accumulated a lot of inventory in that 6-month period. Now, these actually flow into the pool of properties in escrow waiting to close. So that's a whole nother bathtub, right? That bathtub has accepted contracts coming through the faucet and closings going out of the drain. Okay. Right. So you can
that's
see
like the bathtub below the other bathtub.
Exactly. Yeah. Another one that once you count it, it changes. But we count it every Saturday. That both of these are every Saturday. And you can see this general area of what we would consider from 2019 to 2014, a normal area of what to expect. And right here in week 7, this is February, when those interest rates started to really affect demand. And over the last, I think this is like 15 weeks, maybe, we've seen this gradually. We were still normal, and boom, this is 1, 2, 3, 4, 5. This is about 9 weeks right here where we started to dip below where we would expect ourselves to be seasonally at any given moment. So again, it's not plummeting, but we are now, if we were to make any kind of expectation, this would be the expectation at this point without any changes to what's happening. If we see interest rates continue to go up, we could see this come down at a bigger gap. But if everything were to stay literally like it is right now, this is what we would expect in Greater Phoenix.
Okay, so what is that? Say that again, though. What is it?
What is this number? This is the number of everything in escrow. So right here in Greater Phoenix, it takes about, a typical file might take anywhere from 4 to 6 weeks to close.
Sure.
If it's not cash, if there's a loan involved, you need at least 3, 4 to 6 weeks. If you're doing inspections and all of that, basically these are all in the process of becoming closings. Because this is the pipeline, we can expect now that the number of closings coming through our final numbers that gets funneled into, say, the Case-Shiller index, all of these other indexes based on closings, we're going to start seeing fewer and fewer closings compared to previous years.
Right. Interesting. Now, when you say previous years, how far back are you going? Because I think you can almost just write off the last 2 years as a huge anomaly. That was such an unusual, special market. I would if I was doing statistics, I would just sort of take that out because it was so ridiculous.
You'll notice that I actually did take out 2020.
Yeah. Right. Good.
I took out 2020. Yes, I leave 2021 because it was actually normal until Open Door and Zillow decided to have a clash of the titans in our marketplace.
Which, by the way, in part 2, we're going to talk about that and and those iBuyers, those institutional buyers. So that's gret. Mm-hmm. Good. Yes,
but this is almost entirely that phenomenon. It had nothing to do with anything with the general population as a whole. But when we go all the way back, it's not the lowest we've ever been. The lowest we were ever in properties in escrow was about 4,000, and which would be catastrophic. That was right before the crash. And I would say one of the highest we've ever been was probably 2010, 2011, and 12, when properties were so low, it was a no-brainer to go out. You have people buying properties for $50,000. Some properties were selling for less than the cost of my car.
Yeah, right.
So we had lots and lots of listings under contract, but they were extremely dilapidated. They were vandalized. We had a lot of different markets here. But when I say normal market, I'm picking specifically 2014, which was a balanced market for us, and 15 through 19, which was a weaker seller market, which means that you still have generally slightly above or normal demand, maybe slightly below normal supply, but in general, a very good positive seller's market. That's not what we've experienced in the last 2 years. So that's why this is where we're comfortable here in Phoenix.
Tina, just wrap up this part 1 for us. We've got a lot to talk about for part 2, but just wrap up today for us, if you would.
Okay, so what I'm going to do is I'm going to flow through all of these and get to 2 little things here. I'm going to go through all of these different price points, and we're going to discuss. We have 2 different marketplaces. You have under 400 and over 400. Our median is 480,000. Notice that the supply, the reason that we're seeing supply rise in the over 400 market and only slightly in the under 400 market is specifically linked to the demand in the new listings. So demand is down under 400, but demand over 400 in Phoenix is still very, very strong. In fact, it's still hitting record levels for this time of year.
I'm surprised you can buy anything in Phoenix for under 400,000, but yeah. Okay.
Well, you have 2,800 you can choose from.
And this is the thing, by the way, just before we go, this is the thing that really, really is under reported in the market. You know, all of these inventory levels and all of these sales levels, if you were to segment entry-level housing, you would see that this inventory shortage is so much more acute and so much more really devastating in terms of being a seller's or investor's market than anybody is reporting. So Tina, I want to go more into that next time, but we've got to wrap it up. Thank you so much. And we will be back with you on the next episode for part 2. Okay?
Okay.
And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.